Hi, everyone. There's a first time for everything. And today, I think this is my first experience talking to a machine. And I hope everything goes well. So today, we continue what left last time. I think we covered from 1930s to 1970, and we covered the Great Depression, subprime crisis, the Great Depression until 1970. So today, I think we have two cases presentation, and so you should turn off your microphone. I think Tanya and Richard have told you to do so. I don't know if my voice, you heard my voice okay, everyone? And I hope Richard can check it out if everyone hear my voice clear. And later we have two case presentations. I hope everyone, every one of the group members just talks about several minutes, not too long. So you just talk about the case evenly, say 3 to 5 minutes for each group member. So it won't take for too long. And it's my bad not allowing to allow the second group to present last week. 2 weeks ago, last week, I bet. So that right now, this week, we have two cases presentations. I hope everything goes well. This online course is a little bit urgent. There's several reasons. First thing first is that last week we had spring holiday. Lots of people traveled, so that I thought we have to do this immediately instead of wait until next week. That's why I asked Tanya and Richard to send you the information about how to have this course online and starting from today instead of next week. Okay, and right now, because of the pandemic of COVID-19, I think lots of courses have been taught online, and I try to do this as early as possible, so that I don't know if this goes well. Just wait and see. Perhaps if this may go well, then perhaps other courses might be taught in this way. But this is a trend now. Lots of online broadcasting or courses, meetings have been carried out. Therefore, we have to try this sooner than later. Okay. So two case presentations will start right after my presentation, and my presentation will cover things like what Fannie Mae, Freddie Mac did in 1970s, and we should start from Ginnie Mae, right? And I think you remember. I should have a little bit of longer chalk. Okay, yeah, go get some longer chalk. I think you know the timeline many times. And I drew this timeline before. So I'm out of the screen. Not yet. Okay. I bet there's a half of the other blackboard being covered. Okay. And I think at the very beginning of the class, we talk about what happened in 1970 and 1930s. And now we get up to 1970, and I think we talk about the beginning of the asset securitization was in 1970. The first Tanya was on the screen, although you try to hide from, yeah, but somehow you were in the camera. And so we have a Fannie Mae. Fannie Mae started in 1938, and Freddie Mac in 1968. And now, getting up to 1970, we have Ginnie Mae. Okay. 1970. So at this point, asset securitization officially started. The reason is that the first asset securitization product started in 1970. And the first product named Ginnie Mae 1 and 2. Okay. Ginnie Mae 1 and 2. Okay. And so now we need to kind of explain what they are or they were: Fannie Mae, Freddie Mac, and Ginnie Mae. Ginnie Mae was part of the U.S. government, and Fannie Mae and Freddie Mac were privatized in 1968, when Freddie Mac was created, and Fannie Mae was created a long time ago, 30 years ago, from 1938 to 1968. The two institutions were privatized. When they were privatized, the government should do something to replace the roles of the two organizations. Okay? So Fannie Mae apparently was to help the very fragile financial institutions back in 1930s. Okay? And all the financial institutions, particularly commercial banks, were kind of helped or saved by the mechanism of the creation of Fannie Mae. Okay? One more thing. Is the teaching recorded now? Okay, all right, good. So next, so anyone who is absent might watch the video again in case, or anyone else wants to look at what the course, this specific section is about. So they have the opportunity to review. So the two institutions were privatized. Then the government should do something to replace them by setting up a new organization called Ginnie Mae, Government National Mortgage Association. Okay? And you may have the question, why the first product of asset securitization named after this government institute, Government National Mortgage Association? And what did Ginnie Mae do in 1970 when it was created? And the first product was named after this specific institution. Then we need to know how Ginnie Mae 1 and 2 worked back then and up to now, 2020. Okay? 2020 today. The product, Ginnie Mae 1 and 2, has been in the market for the past 50 years. Okay? The product is very popular for lots of so-called institutional investors. Then I need to show you how Ginnie Mae 1 and 2 worked back then. And because this is the first product, I need to explain how they work, how they work, and how they function as a kind of conduit from home borrowers to investors. Okay, it's a kind of long story, and the process takes some time, and you need to know who is doing what. The process. So when we define asset securitization, the product is a symbol of everything else. If you know Ginnie Mae 1 and 2, then you can easily understand what asset securitization products are. I mean, say Fannie Mae and Freddie Mac's products, Fannie Mae MBS, or Freddie Mac's PC products. They work about the same way as what the Ginnie Mae 1 and 2 did or does now. Okay. So at the very beginning, and we talked about the kind of fragile financial institution, particularly banks, commercial banks back then, right? Commercial banks were in crisis. Lots of banks were saved by first deposit insurance and then by Fannie Mae, because Fannie Mae purchased mortgages which were conforming loans to the regulations or the requirements required by Fannie Mae. Okay, and back then, lots of mortgages, right? Remember, mortgage. Okay, perhaps I should turn this side so that you can see me. And so mortgages were purchased by Fannie Mae back then, but now Ginnie Mae suddenly issued the two products or just one product. How about that? Instead of Ginnie Mae, we put them 1 and 2 as one product, and then we use Ginnie Mae as the product name. Ginnie Mae was, Ginnie Mae issued the first product. You may ask the question, why so? Why Ginnie Mae issued the very first product instead of Fannie Mae and Freddie Mac? Why? And what Ginnie Mae did before in 1970. And actually, Fannie Mae and Freddie Mac issued their products in 1980s instead of 1970. It's a kind of 10 years later. Ginnie Mae was a government unit, government entity, or so-called GSE. Okay. Ginnie Mae was a so-called government. Once again, I don't know which way you can. Either way. Government-sponsored entity, okay, in abbreviation, GSE, okay. So you may ask yourself, how can one government entity, such as the Ministry of Education of Taiwan or your country, can the Ministry of Education issue any kind of bond or any securities to the general public? No. Then how can Ginnie Mae issue so-called Ginnie Mae 1 and 2? Is that the story how it went, like back in 1970? No, Ginnie Mae did not issue the security. Then how the story went, when Ginnie Mae issued Ginnie Mae 1 and 2. Apparently, Ginnie Mae did not issue Ginnie Mae 1 and 2. So remember, if anyone in your life circle, say relatives, parents, friends, saying that, oh, Ginnie Mae issued Ginnie Mae 1 and 2, that is a wrong statement. It's a wrong statement. Ginnie Mae did not issue Ginnie Mae 1 and 2. The next question, how can an institution issue did not issue something, but the securities carried its name. Don't you have that kind of puzzle or question? Question mark, why we have that kind of products issued by, not issued by the government entity. Instead, we use the name of the government entity, say the Ministry of Education, Ministry of Transportation. Can they issue any securities named after them? No, definitely not. Only the government as a whole is able to issue securities, or the central bank issues some government bonds and so on. So government entities are not allowed by law to issue any securities. Okay? And Ginnie Mae 1 and 2 carries some kind of a government face value to convince investors that it's about time to make the financial market complete. Okay? Then 1970 could be the beginning or inception of asset securitization instead of 1938 when Fannie Mae was created. Okay? Then let's assume one bank named NTUST. We start from NTUST Bank. Now I'll show you how Ginnie Mae 1 and 2 created, how it worked back in 1970. Okay? Ginnie Mae did not issue. So remember, Ginnie Mae 1 and 2 are not issued by the government. But how it works, that's the trick I'm going to introduce to you. Okay. Okay, now erase this. So you just remember the three entities, the three institutions are GSEs. This one, government unit, government entity, but these two are private companies. Back then, they still purchased mortgages from commercial banks in order to make the financial market complete and make it work, to save the economy, to save financial market stability. Now, back in 1970, Ginnie Mae tried to make it the kind of play the role of the two private institutions, Fannie Mae and Freddie Mac. And these two companies are private. So the name implies private companies are not controlled by the government. But actually, these two institutions were still under the government control in an implicit way instead of explicit way. Implicit way means that some board of directors were appointed by the US government. To be specific, appointed by the President of the United States. Okay, but the US government has not appointed any directors of the board since 1968, after the two the Fannie Mae and Freddie Mac were privatized. Okay. Although the government or the president had the right to appoint some directors, like 3/7 or 2/5, and so on. So the US government wants to put some control over the two private institutions, but the US government has never done that since the beginning of, since Ginnie Mae was created. So Ginnie Mae was created to help or to play the role of the two private institutions. And so the bank, NTUST Bank, was trying to do the same businesses as usual. So NTUST Bank would sell loans to mortgages to Fannie Mae, Freddie Mac, and so on. But now, NTUST Bank wants to create something from nothing, i.e., NTUST Bank wanted to create some securitization product, but now there's nothing in the market. And Ginnie Mae was created to help the so-called commercial banks to issue something named after Ginnie Mae. So now the commercial bank must set up so-called SPV. If you read the cases, you understand what the SPV is, right? So the other two or the three names can be used interchangeably, okay? SPT, SPC, and so on. Either SPV or SPT or SPC. Oh, I'm off the screen. I should be back. Okay. So I'll make it a little bit vertical. Right. So NTUST Bank have lots of mortgages. Okay. And before, without the program called Ginnie Mae 1 and 2, oftentimes NTUST Bank may just sell its mortgages to Fannie Mae and the Freddie Mac, correct? Just like before. But now, if NTUST Bank wanted to do something differently, then they firstly, we call it true sale of its mortgages to special purpose vehicle. I spell it out. Okay. Special purpose vehicle, right? And this is a special purpose trust. And this is a special purpose corporation. And now NTUST Bank wants to create something from nothing, but no one has done anything before. Now Ginnie Mae came into the picture. Ginnie Mae came into the picture. So now we have investors right here. So you just remember, no matter what securities or products, real products or financial products, when you create something, you must find the markets for sales, right? You have to sell something to investors, buyers, sellers. Now, NTUST Bank wanted to do something differently, and they want to sell something to investors. Before, they just sell mortgages, or if say you may call deposits one of the products they sell to investors or depositors, right? And now they wanted to sell something to investors in a different way. We call it asset securitization process of this whole thing. Right? And if we don't have a special purpose vehicle, what can or could NTUST Bank do to remove of mortgages? Just sold the mortgages to Fannie Mae and Freddie Mac. No big deal. Just like, business as usual. We just did it like what had been done through the channel of so-called mortgage purchasing program done by the two GSEs, right? Fannie Mae and Freddie Mac. But now, the NTUST Bank wanted to true sale, not sell, okay? True sale. But how about let's make a little bit twist and turn, make the story a little bit different before we go through the so-called Ginnie 1 and 2 creation. Okay. Now, if NTUST Bank wants to sell one of the mortgages to you individually, okay, you guys want to buy one mortgage, say NTUST Bank lent money to me to buy a house, so I owe some money to NTUST Bank, and the document is called mortgage. Okay? Money I received is spent to buy a house. Now, NTUST Bank wanted to sell the document of the mortgage to you directly. Will you take it? Somehow, I'm unable to name any of you because I couldn't see the names yet. It's a drawback for the online course. I'm unable to call your name or to ask you to answer. Or anyone wants to buy the document, say, NTUST Bank lent me $10 million. Now, the bank wants to sell it to you, $10 million mortgage. And if you buy it, you're going to receive monthly payments throughout the following 10 or 20 or 30 years. Continuously. You're going to receive interest payment and the principal payment for the rest of the duration, say 10, 20, 30 years, depending on how long your mortgage is or was. So now, if you purchase this, or if you purchase this mortgage from NTUST Bank, what would be the risk and return? Can anyone talk to me? And you just turn on your microphone and talk to me, but not. How can we do this? If more than 10 people want to talk to everyone else, how can we do that? It's still, I think classroom is the best way to teach instead of online. So, or we may have someone to say, if you want to talk, just turn on your microphone, and then anyone, if you want to buy it or you don't. If you want to buy it, can you tell me what risk and return you might have? What might be the risk if you purchase the mortgage sold by NTU?
I can say.
Okay.
I think the risk can be that, for example, if I lose a job, that means I cannot pay the loan continually.
Okay.
And that means I have some troubles.
Yes. Okay. That's a good point. You mean that I might be laid off, right? Because I borrowed money from the bank. But that's a good point. You kind of bear the risk of this so-called foreclosure, right? I may default in case the price of the house, of my house, falls. I may default. I don't want to pay because the price of the house falls below, say, $5 million or $3 million. Then you, as a buyer, may lose money, right? That's the big risk.
Yes.
So, right. Okay. Good. Very good. Thank you. Good. So you just turn on your microphone, but not all at all at the same time. So I think this is good. At least we are able to communicate. If you want to turn on, you just say, I don't know how it works, but just turn on your microphone, and then can we see there are more than 10 people turn on the microphone, or 1 or 2? But in case there are more than 10, how can we control the flow? No, because this today is a try and error. We try to make it good. If we continue to do this next week or more than 2 or 3 weeks, then we have to adjust accordingly. Yes, go ahead. Anyone want to talk? Okay. Anyway, yeah. It's kind of weird to talk to a computer, although everyone is online, but I'm talking to a computer, and you are listening to. I mean, I think from watchers' perspective, it is quite normal. Just you are watching TV, right? But I am different. I mean, I'm in a very different situation. I'm talking to a computer or a camera, for instance. So I have to be used to it. I become, I don't know, internet celebrity or something like that. I try not to be, but this is how it works, and perhaps you have to adapt it to the new so-called the new normal, right? And perhaps not because of the pandemic. And very soon we have to do this here, there, meetings later on when you graduate from this program, or you may just go back to your country or find a job. So I think we need to be kind of familiar with this kind of settings sooner than later. Okay? And talking to your colleagues, talking to your families in this way. Perhaps not because of the virus spreading so fast, so viciously. So everyone has to learn new things. And as my age, I'm still learning some new tricks like this, right? But anyway, so I think previously, I don't know who's talking to me, but anyway, there's a big risk. If you buy one mortgage, just one, okay, you kind of bear too much risk, although you have high returns compared to other investments. But this one, if you buy one mortgage, then you bear kind of huge risks compared to other investments. Okay, now NTUST Bank did something differently back then in 1970. Mortgages removed, we don't call it. So previous example, NTUST Bank sold my mortgage to the lady early on. It's called, how about we call it another name, called the real sale, not the true sale, real, okay? Although I create this term, a real sale, to the previous lady, okay? But now we want to remove mortgages from NTUST balance sheet to SPV, okay? Say, how about we call this golden mortgage, okay? Make it real, golden mortgage. I think I'll be safe for NTUST to remove this. I mean, I'm safe, meaning that I won't be laid off unless the earth was in great crisis. Otherwise, I think I'm a public servant. So just in case, I won't be that risky. So I'm a kind of safe borrower from in NTUST Bank's balance sheet. I'm a safe asset. So removing the assets to SPV, okay? My mortgage right here, right? So SPV has assets. SPV owns assets. So now, if there are more than 1,000 gold Okay, 1,000 goldens in this portfolio. And you know, when we remove the assets from one institution to another, in this specific arrangement, we call this off-balance sheet. So this is kind of a special jargon for asset securitization. So you have to understand this. Off-balance sheet transaction or true sale. So I think there's a case, either the 11th or the 12th. That case is dealing with one very popular security called cover bond. Okay, cover bond will be covered later when we get to the specific case. Cover bond transaction is dealing with on-balance sheet. Okay, a little bit different on-balance sheet. Transaction, i.e., assets remain in the balance sheets of the issuers or the originators. We can wait until when we talk about covered bond. Okay, 1 or 2 months later, when we read or present the very last case, 12th or 11th case. So now, NTUST Bank removes its the assets to SPV, and we have a so-called true sale instead of a real sale to one of you. Okay, that's kind of way too risky to buyer or to investors. So now there are more than 1,000 or 5,000, depending on how big the pool, so-called asset pool. Very soon we'll talk about that. Okay, this is called. There are more than 1,000 golden mortgages. We call it asset pool. Okay, asset pool includes lots of mortgages. Okay, perhaps the mortgages were originated in different regions, from New York to California, from Washington to Florida. Okay, or the mortgages could be originated in different part of the world. I mean, different part of the United States. So when we have a asset pool of mortgages, I think you learn corporate finance last semester or somewhere else. The purpose to have an asset pool is to diversify. Okay, diversify diversify the portfolio into different regions. So some areas may have financial a little bit of recession, but other cities, other part of the United States may do quite well. So this pool kind of represents diversification of portfolio in the asset side of SPV. When NTUST Bank removes its mortgages to SPVs through the process called true sale or balance sheet transactions, NTUST Bank will no longer, you keep that in mind, NTUST Bank will no longer have the claim on the assets. Are you with me? That is, in case one of Gordon's defaults on his or her mortgage, investors have no right to claim, take it back. Investors, I have to rephrase my statement. Investors have no claim on NTUST Bank assets. Put it in another way, NTUST Bank well-being or healthiness or financial healthiness has nothing to do with investors. Okay? So true sale or off-balance sheet transactions mean something to investors. And this is how or why asset securitization is or has been so popular among investors. And this is one of the mechanisms that is very different from what the cover bonds do in Europe. Cover bonds are very popular in Europe, particularly in continental Europe. Okay, Germany, France, the Netherlands, perhaps Belgium, Spain, and so on. But everyone knows that Germany is the leading economy in Europe. Okay, so cover bond is very popular in Germany. So it's important in the European continent, and lots of investors would rush to buy cover bonds. One of the reasons is that investors, listen carefully. In asset securitization, by this design, investors have no claim. You listen carefully. Investors in this process have no claim on anything related to NTUST Bank, nothing. Or put it in another way, NTUST Bank may go bankrupt. It wouldn't affect the soundness of this structure. Investors won't get hurt by the soundness of NTUST Bank, nothing. But cover bonds mechanism will kind of not allowed. Investors of cover bonds will get hurt or get losses because of the bankruptcy of any bank, who issue so-called cover bonds. You know the differences? I don't know which mechanism, which model you prefer. We'll talk about that for the comparison when we get to the case of cover bonds. Okay? But now we just keep that in mind, the two different systems, Europeans, Americans, do businesses differently. There's no right or wrong answer to the question, okay? Because asset securitization kind of guarantees investors, not guarantees, I take it back. Investors in asset securitization markets kind of get protection from this mechanism, so-called off-balance sheet transaction. Investors won't get not affected. How about I put it this way? No matter how bad or how good NTUST Bank does after the securities or Ginnie Mae 1 or 2 issued, okay, after that, no matter how good or bad the bank performs, investors kind of get protection from anything related to NTUST Bank. So that's the design of asset securitization through this mechanism, okay? SPV, kind of a intermediary that protects investors from the performance or the soundness of the originators. One of them, say, is NTUST Bank. No matter how good or bad the bank does, it won't, I mean, the performance or soundness of the bank won't affect risks and or returns of investors' investment. I don't know if, do you like this mechanism or the other mechanism? When we talk about the case, then we can compare the two systems. Okay? I think you remember Washington Mutual, WAMU, was bankrupt at the peak of the subprime crisis in 2008. WAMU issued the very first covered bond. Unfortunately, the company went bust, but Europeans have been issuing cover bonds, I think 100 or 200 years in history. Okay, so different systems, different preferences over risks. So 40 minutes passed. I think I'm doing okay so far, right? Okay, so you can't talk. I can't see your face. So I don't know if you like it or not. Kind of, you know, one-way street, one-way conversation. Not so good, but at least we're safe. Everyone's safe, right? So you stay safe as much as you can. Try not to, you know, so be safe and be healthy, right? So now, you know, the design of asset securitization is to protect investors from bankruptcy or any, you know, anything related to the issuer or the originator. So that's the design of the asset securitization. So we have the asset pool here, okay, SPV, special purpose vehicle here, and remember, SPV owns, listen carefully, SPV set up by NTUST Bank owns the assets. That's why we call it this transaction bankruptcy remote. Full transition. I don't know if you can, yeah, yes. I think you can see. I set up the camera that you can see in the bottom of the blackboard. So this is called the bankruptcy. Can you read it okay? Bankruptcy remote. I think this is a kind of asset securitization jargon, or special term here. Bankruptcy remote, i.e. the transaction will give the kind of attorney power to SPV. In turn, investors have the power to kind of avoid any bad performance of NTUST Bank. Okay. But is that true? That NTUST Bank's soundness wouldn't affect the investors' assets? I think that's a big question or very important question. Back in 2008 or now 2020, lots of companies or financial companies have been doing originations, have been doing securitization and so on. And some of them perhaps are in crisis because of the pandemic. Right now, real estate transaction has been halted. Okay? And if that is the case, the quality of the assets might be in trouble. Might be, okay? Just like subprime mortgages, they are kind of risky assets. If you put the risky assets here, and investors might, you know, bear some risks. because of the quality of the pool here. Although the bank has nothing to do with the assets. But more than less, if this is a good bank, perhaps you can infer that quality of assets is good. If this bank is not doing so well, then you may question the quality of the assets here. So it's kind of it's a cycle. If this is good, quality of the assets might be good. If this is bad, the quality of the assets might be bad, right? So it's kind of you know, chicken and egg stuff. Who's leading the other? Okay, if this is bad, can we convert this to the quality of the bank? Well, so this is kind of cycle, and so sometimes these two things might be affected to each other. Good bank may have a good quality of assets, and bad bank may lead to the bad quality of the assets, and so on. But some other times, you listen carefully, good banks may kind of remove bad assets to SPV. Okay, it's, you know, we are human, so we may do, you know, good people will do bad things, or bad people sometimes do good things. Okay, so, and who is in charge of the quality stuff? Anyone wants to give a shot? So who's in charge of the assets? Or someone else? Anyone wants to share your thoughts? Anyone? Hi. No one? Yes? No? Hi? No one wants to. So investors have right to check the quality. So I haven't talked about the security. Say Ginny May right here, right? I haven't talked about that yet. Will be sold to investors. So during the process, who is able to evaluate the quality of asset pool? Everyone, or investors, or someone else? Anyone? Based on knowledge you may with us? Anyone? You just turn on your microphone and talk. No one? Yes? No? No? Yes? Anyone? No one? Please, or someone sitting in the classroom. Anyone wants to? So other than, so I think investors are in to check or evaluate the quality of assets. Of course, you're entitled, because you're an investor, right? You're entitled to evaluate the quality of assets. But naturally, right? Then if you are a non-financial professional, right? You're perhaps IT professional. How can you judge the quality of assets you're going to buy, or something you want to buy, but the so-called something is based on the assets? Then how do you do the so-called check and balance, right? So you have the legal right to check the quality. How and who might be able to help? Anyone? Lawyer? CPA? Consultant? Me?
Is it rating agency?
Yeah, rating agency is very good. Who's this?
Vincent.
Oh,
From
Vincent.
Indonesia.
Okay, thank you. Yeah, rating agencies. So anyone else wants to comment on it? Yeah, rating agencies? Of course. Rating agencies. I put another color so that we won't get confused. Rating agencies. Yes, very good. Rating agencies. Who else might be able to help investors? Or you know, Yeah, Vincent, comment on it. What else? Who else can do the? Will investors pay for the evaluation or SPV have to? Please.
Hello. Can
Yes,
you
I
hear me?
can. Go
Oh.
ahead.
I'm not sure, but if any security is really widespread in financial market and its performance can really affect all system, I think any governmental authorities, like for example, Securities Exchange Commission, can also be interested in checking the quality of these securities.
No, I don't think so. No government gets involved in the. I take it back. Good point. I'm not saying the government gets involved. I think this is a good question. Does the government or the US government get involved in the so-called checking the quality of assets? The answer is yes or no, right? Because if you want to be qualified to issue Ginnie Mae, okay. Now I think it's a good comment. Of NTUST Bank to do this process can, let's say, another bank called NTU Bank, all right? Can NTU Bank does the same thing? Yes, they can. They can do the same. Okay, NTU Bank, another bank called NTU, our rival across the street, NTU Bank, right? Can NTU Bank does the same thing? Yes, they can. Just do all the process. Okay. What all the banks do will have to conform Ginnie Mae's requirements. So anyone in the market, any bank in the market can do the same, okay, so long as they follow the rules set up by Ginnie Mae. Okay, not just NTUST Bank, NTU Bank, NCCU Bank, NTNU. Any bank in the market can do the same. But they have to do the so-called, they have to go through the process or requirements required by Ginnie Mae. Then perhaps you're right. Okay, the government gets involved only in that sense. Ginnie Mae sets up the rules, regulations. Okay, all banks must follow the rules. And why would Ginnie Mae do that? There must be something as a compensation. In that sense, Ginnie. Okay, so just remind me of the schedule. So I'll let the group 2 to present in 30 minutes, and the group 3 to present the third case in 30 minutes. And so we start at about 3 o'clock. I mean 3:10. How about that? We take a 10 minutes break after 3. Okay, so I need to finish up. So I try to finish up this fast. Otherwise, we couldn't do the presentation. I hope we can finish 2 cases today, and we kind of catch up the whole thing. All right. So now, so yeah, that's a good comment. Ginnie Mae would look into the process if they conform to all the requirements. Okay, and I think that's very much like subjective evaluation instead of very objective. So all banks in the market must conform to the requirements. Then if you meet the requirements, you just do whatever you want. You may pay to investors much higher returns or interest rate fine, so long as the quality of mortgages meets the requirements by Ginnie Mae. And during the process, Ginnie Mae will get some compensation. Okay? It's called guarantee fees. Guaranteed by Ginnie Mae. That's why the securities are called Ginnie Mae 1 and 2. Not because Ginnie Mae issued it back in 1970. You have to remember this. Lots of financial professionals, practitioners in the market, unless you're in the United States. Okay. Other than that, most of the people in non-US markets don't really know who is issuing Ginnie Mae 1 and 2. Everyone can issue. I mean, any bank can issue Fannie Mae, Ginnie Mae 1 and 2, so long as you kind of meet the requirements. Okay, set up by Ginnie Mae, the so-called GSE. Okay, so this is quite important, and that's a good point. But the government, I think, Ginnie Mae plays a passive role instead of an active role. Okay? You pay me as a Ginnie Mae the guarantee fee, and then I kind of so Ginnie Mae plays as an insurance company. Okay, you pay me some guarantee fee in case some of the mortgages in this portfolio or in this SPV defaults. Okay, in case I will pay you the coverage. Who gets the coverage? Investors, right here, right? So this process guarantees lots of people, or make sure investors are safe. But nothing is safe as, rocker or death, right? Everyone will be dead sometime sooner or later, right? No one can guarantee you the security is safe. Okay? Even though we have collaterals right here. If this is so safe, how could we have a subprime crisis in 2008, right? Apparently, there's no such thing as safety in financial markets, correct? So it's pretty much like caveat emptor. Any buyer or customer must be aware of the quality of the product you're buying. Instead of, oh, this is very safe. If you buy it, nothing is risky. Wrong statement. Okay? So now before investors buy the securities, rating agencies come in to rate Ginnie Mae 1 and 2. In general, these Ginnie Mae 1 and 2 rated, how about anyone guess it? Triple A, triple B, double A, single A? Take a guess. Triple A, all right. Well, of course, the government give you the guarantee, right? You just pay something, some money, some rate. So I'll give you a quick review. Right here, we have lots of mortgages, mortgage pool, asset pool, right here. Let's say this pool will give, kind of provide 10% interest to SPV, okay? And NTUST collects principals and interests every month and pass all the cash flows to SPV. In turn, SPV will distribute cash flows to investors every month. Then, will investors receive 10% of the cash flows? Of course not. You have to pay some fees. Okay. On average, investors, in this case, specifically for Ginnie Mae 1 and 2, investors will receive less than 10%. Perhaps investors may get 9% as return or 8.5% as return, depending on fees, commission fees, or who's doing this transaction, who's helping SPV to distribute cash flows to investors. Take a guess. Oftentimes, investment banks. investment banks are doing this stuff right here. Investment banks are doing the distribution, designing, all the things considered, all things considered. Investment banks are doing the design, all the structures, stuff, and the most important factor in the process is that who is the investor? Where to find investment? Investment banks have the know-how, have the potential buyers who will buy what, how much. Investment banks have the information, have the relationship. That's why Lehman Brothers, Goldman Sachs, Merrill Lynch, all the investment banks know a lot. Okay, although sometimes they did too much. Okay? Just like Lehman Brothers did too much, did too much. Oftentimes, Lehman Brothers perhaps invested back then in some products they designed themselves, but eventually, we call it. Suddenly I forgot the term in English. Okay, I'll tell you some other time. So rating agencies will collect some rating agencies fees. Ginnie Mae will receive the guarantee fees. NTUST Bank will service cash flows. All cash flow. Everyone who gets involved in the transaction will get some money, get some fees. Okay, that's why finance is fun. So long as you get involved in any transaction, you get paid. Just like me, I'm teaching this, so I get paid. Okay. All right, and pretty much like the very basic transaction, and a Ginnie Mae one was the first product, and later on we will talk about other MBS, other securitization products, and this is kind of the founding block of asset securitization. So you can kind of take a guess at the very beginning of any industry, any products, will Ginnie Mae 1 and 2 be very complicated or very simple? Answer is, anyone? The feedback is so slow.
Very simple.
Very simple, very good. Okay, 3 o'clock, very simple. So when you start doing things or create some new businesses, just remember, you just start from very simple stuff instead of thinking way too complicated structure, business, or products. Simple product at the first stage. And Ginnie Mae 1 and 2 are very simple. Everyone can get involved. Even until today, the products are very simple. Okay, very simple. So this is how it works. And perhaps I missed something here, there. But I think this is very basic process, although I kind of jumped a little bit further instead of talking about the features of asset securitization or what they are, how the functions. We may get back to the functions, but somehow we have to finish 2 cases presentation. And keep that in mind today. And everyone, when you present, I hope you present just within 3 or 5 minutes instead of way too long. Just time your presentation, 3 minutes, 3 minutes to 5. So how many members in one group? 4 or 5. So I think 3 to 5 minutes, maximum is 5 minutes. How about that? Do not, talk on and on and on and non-stop. Please just control your time, and let's take a 5 minutes break. Each do whatever you want. I can see how you take a break, whatever. When we just resume our case the class at 3:10.